everyone, welcome to the Big Picture Retirement Show. I'm your host, Devin, joined by my co-host, John Ross Esquire.
Howdy.
John, happy to have you back in the studio. We're getting ready to go into summer. Summer's going to be crazy. We might end up taking some time off.
Maybe.
Just because we're going to be separated. I'm going to be out.
Well, you're
working
touring the
remote
world
for a while.
And such.
Yeah, right. Not hardly. My family won't do a long plane ride, so we're going to be stuck.
It's because you won't spring for the first class.
No,
you spring for the first class.
Right
you watch them take long plane rides.
I bet they would.
Yeah.
I'll bet they would. No, not in the Devin and Karen Carroll household. That will not be happening.
And hey, if you're going to pick a financial advisor, pick one that flies coach. That's somebody that knows their money.
Well, I guess so. Now, don't look when the kids are gone, though, because at that point, it might be first class.
Well, that goes back to enjoying your retirement.
Absolutely.
Yeah.
Well, let's talk about retirement, and let's talk about taxes in retirement specifically. You know, when you're working a job, let's say that you're an engineer at, IBM. You're getting a W-2, and that W-2 is pretty easy, right? You're getting a salary plus probably some bonuses, some sort of incentive compensation, and they're withholding taxes.
Yeah, doing your taxes when you're a W-2 wage earner
Easy peasy.
Easy. You do it on TurboTax.
That's it. Very easy.
Maybe you itemize, maybe you don't.
And in most cases, just about everything you earn in retirement is taxed one way, right? It's just
Ordinary income.
Ordinary income hits the federal tax brackets, maybe state if you live in a state that does that. And that's it.
Yeah,
but then you retire and things get wonky.
Yeah, all of a sudden you got a lot more, you've got a lot more types of income coming in.
Yeah, you do. So it turns from all of a sudden you just had this ordinary income coming in from your salary to now you've got Social Security, you've got distributions from your taxable account, you've got distributions from your IRA, you've got potential capital gains, you've got dividends. Those dividends could be qualified or ordinary dividends. You've got potential equity compensation that could be paid out that's taxable at different rates and levels.
Right. You might have invested in some rental property or something, so you've got rental income that's coming in one shape or form.
You might have a side hustle.
You might.
Where that side hustle, especially this is very popular with engineers, where they do some consulting work. Sometimes that consulting work is set up as a W-2 employee. Sometimes you're a contractor.
You know, I live in Hot Springs half the time, right? Yeah. Nice lake up there. Actually, 3 lakes.
Yeah.
You know, big.
Yeah. It is nice.
So Lake Hamilton, there's a Facebook page for the Lake Hamilton boaters. So it's just all the people that have boats on Lake Hamilton. And you know, a lot of times it's just people complaining and such.
Right.
But
yeah. About all the jet skiers, probably.
Well, mostly the wake
and the wake boats.
The wake boats.
Yes,
it's
the wake boats and the jet skiers.
Yes. And my biggest complaint with the wake boats is their choice of music, which I think comes pre-installed on the wake boats.
There's a wake boat playlist.
Because it's god-awful. It's just the worst. Anyway, but there was a post from a guy, and he was But you talk about side hustle in retirement. So here's this retirement guy. He's got him a nice boat. Mm-hmm. He lives on the lake. And you know what he does?
Tell me.
He takes bachelorette parties out on his boat.
No kidding. Yeah.
So when the bachelorette parties are coming to Hot Springs for their bachelorette weekend, they can rent his boat. He captains it, so they don't have to worry about drinking and driving and all of that. He knows all the places on the lake to go and hang out. And so loads them and their coolers up, and he drives a group of young ladies around on a nice, beautiful, sunny summer day.
Wow.
That's a heck of a side hustle.
That's a gig.
And he gets to write the boat off.
Yeah, how about that? Not a bad deal. So when are you starting your service?
Maybe this weekend.
The start of summer and John's new job.
I'm telling you, I was just like, hey, I can appreciate the side hustle there, right? I mean,
absolutely.
That was great. That's good idea. Anyway, but the point is, so he's got revenue coming in, but you know, now he's got depreciation expense on his boat, and there's probably some personal use with the boat, so he doesn't get to take all of the depreciation. He only has some, or maybe it's just using it for the business. And
I'll bet it's mostly business use.
you know, but according to his tax return, it's mostly business use.
Right. Yeah.
But you know, so all of a sudden you get all kinds of tax issues
Yes.
that guy probably never had to worry about, like you said, when he was an engineer with L3 Harris.
Absolutely. But, you know, let's just assume, though, that someone isn't, they're listening to this and they're going, well, I'm not buying a boat and taking a bunch of scantily clad women around or doing some kind of consulting on the side. I don't want to do all that. That's why I'm retiring.
Right.
My plan is all I'm going to have is my taxable brokerage account, my IRA, and Social Security. That's it.
Still got three different things,
Those three things. And then yet within those three things, yeah, you've got the taxation of ordinary income from distributions from your IRA. Then you've got the capital gains and dividends that's coming out of your taxable account, plus maybe some non-qualified dividends and interest income that's coming out of there.
And then you've got your Social Security, which is not taxable unless it is taxable.
Right. And it's only taxable based on your other income sources.
Exactly.
So then you've got all of these different types of taxation, and they are all interlaced and all interact with each other. And that's where taxes in retirement get more complicated.
Yep.
Because nothing happens in isolation when you're retired. Just about everything you do has some sort of ripple effect with this over here.
Right.
Right? And we'll get into an example of that in just a moment. Let's hit the big categories in retirement, though, John. We have ordinary income.
Sure.
So ordinary income is just, you know, that's like your wages, right? Except there's no FICA tax applied to it. So it's just subject to federal income taxes, state income taxes. Every dollar you pull out of your IRA is taxable at ordinary income rates.
Right.
Right? Just like your wages. If you earned $1 more, guess what? You owe tax on $1 more.
Interest, ordinary dividends, all ordinary income.
That's it. All of those are ordinary income. But then you have your preferential tax rates. And those are your capital gains and dividends. And, you know, you can look at the tax grids every year. The thresholds generally increase on an annual basis, but there is actually a 0% bracket for those right now. I'm not even sure what the pending tax legislation that we have out there is going to do with that.
Yeah, we're waiting until that makes it through the whole deal before we do a probably series of episodes.
So. And I think that's worth a side note. This is big. This really is a big deal. In fact, just yesterday, I talked with a team here, and generally, we take our client service calendar and we have it broken up into segments. And we have these two big pieces that happen every year. The first is our annual alignment meeting, where we talk about the year ahead. And then the second piece is our plan update, where we update that long-term plan. We generally do that plan update starting in the mid of June, all the way up through the end of August into the September. So here we are. It's time for us to start sending out emails to start collecting information to do these plan updates. And I talked to the team yesterday. I said, what do we do, guys? You know, we have this tax legislation that's pending. The president said he wants it on his desk by July 4th. I don't know if that's going to happen or not, but if it does, and we have already worked through 50 of our plans, I know our clients.
Yeah.
And I know what they're going to do. They're going to come back and say, hey, you know, now that law's changed, let's redo that.
Yeah. For my clients in the estate planning side, where there's estate and gift tax issues and stuff like that, yeah, we are in a holding pattern.
Yeah.
I've had several that we were working on stuff at the end of last year, and then once we saw how the election came out, then basically everything just shut down, and we just went into a holding pattern to see what is going to roll out, and we're still in that holding pattern. So,
and that was a bit of an aside from what we were talking about, but I do think that it merited a pause button there for us to say that, hey, this is a big deal. We're pushing our planning up a little bit so we can see what's going to happen here before we jump into that. So you've got ordinary income rates, then you've got your preferential tax rates, and then you've got other things that aren't necessarily defined as taxes, but they kind of are, right? Because they're based on your income, and that would be your Medicare premium surcharges.
Yep.
So if your income goes above certain thresholds, then you have to pay additional Medicare premiums for your Part B and your Part D. You also have the net investment income tax, where if your modified adjusted gross income goes above certain thresholds, then your investment income also gets sucked into an additional 3.8% tax. And what's not even in my notes here would be for those people under 65, another kind of something that functions as a tax would be the ACA premium credits, right? The premium subsidies. You know, if your income goes up to a certain level, then you've got to pay for the entire ACA premium for your healthcare insurance. So for those people that are under 65, the lower your income is, the less you pay. The higher your income, the more you pay. Well, that sounds a lot like a tax to me.
Yes.
So you've got all of these different pieces that are interlaced, and understanding how all of this is layered together and how to be strategic with that in retirement is where things really start to get complicated. And John, I'll tell you, I hear from a lot of engineers, a lot of really smart people engage us for our planning. And a lot of them would tell me the same thing. Devin, I've got some really complex spreadsheets, but there's one piece I just can't get right: the taxes.
Yep.
And I understand why. We've got some guys on staff here that are in it. The guy that recently left, he wanted to go back to school, pursue another field. He was really good with Excel. And there for a while, we chased building our own retirement calculator in Excel, and we got really, really close. But because of all of the different ways that the taxes ripple
because
out,
you change one thing here and it changes another. It changes three things over here.
We just couldn't do it. So we just had to kind of surrender, throw up our hands, and start going back to the regular old software that we were using. So you've got all of these different pieces that are out there, and now you're retired and you have to figure out, all right, I've got enough money to retire, right? Most of the people that contact us, that's what they say. Devin, I think I've got enough money to retire. I certainly want to test for that. Let's look at some stress testing here. So let's make sure we're fine there. But most of them are pretty sure they're fine, and most of them are. Mm-hmm. Most of them have more than enough to supply all of their income needs, even if we have very low rates of return. But the fear that they have is, I'm going to screw something up with my taxes.
Right.
I'm going to end up taking a distribution in a way that is not optimal. You know, if I just deplete my taxable account and then I've got these massive RMDs that are going to hit me down the road, I don't know if that's optimal. We need to test some different strategies. And so that's when we go back into the planning and we start looking at that. But this is one of the big fears that a lot of successful retirees have. Once they get up to a certain amount, they're good on, I've got retirement done. Now let's optimize it. Taxes, right? So when we're looking at, ordinary income versus preferential tax rates, let's break it down. And again, I don't want to get deep into the weeds and look at equity compensation, look at side hustles, look at renting a boat full of scantily clad women, owning a boat, whatever it is, right? I just want to look at those big three categories.
Right.
Let's say that you are the plain vanilla retiree. You're retiring. You've got the traditional IRA, which was in your 401k. It's all pre-tax. You've got your taxable brokerage account, just some money that you guys have put back. Once the kids left home, you could save more, and that's where it started going. Very common. In addition to that, you have Social Security benefits.
Right.
I can't think of a more average scenario than that.
Right.
And I see it all the time. So let's break down those three categories and talk about how much more complex it is than a lot of people think it is. And then let's go into some ways that you can mitigate some of those taxes through planning. So first, we've got the traditional IRA or 401k withdrawals. Now, $1 comes out of your IRA. Guess what? You're going to get a 1099 for $1.
That's right.
And that 1099-R is going to show that you took a distribution, and it's going to show taxable amount, $1.
Yeah. That's why I always explain it to people. It's like you went out and got a job and they paid you $1.
Yep. That's it.
The only difference is instead of getting a W-2, you're getting a 1099-R.
Yep. That's pretty much the way it works. Now, what's interesting, though, is that it would seem that, okay, so I took $1 out of my IRA. That means I increased my taxable income by $1. Not necessarily, because now that $1 out of your IRA is going to increase the taxable portion of your Social Security. It's going to at least start to move you through those grids. Mm-hmm. It's going to increase how much you pay if you also take a capital gain. And that dollar, right? Nobody's going to just take $1 out, right? We're just using that hypothetically. That dollar distribution will also start to move you through the grids for the IRMAA and the net investment income tax. And if you're pre-Medicare age, also start to move you through phasing you out of the premium subsidies.
Yep.
So that's some of the interplay that comes out of the distributions from a traditional IRA, right? Then we have Social Security. Now, with Social Security, between 0 and 85% of that benefit can be included as taxable income. And if it is included as taxable income, it's taxed at ordinary rates. All right. So just like your job, right? So if, let's say hypothetically that you get $10,000 in Social Security benefits and 85% of that is taxable, that simply means that $8,500 is going to be added to your taxable income, ran through those ordinary income rates. Very simple. To calculate this, though, they use what's called the combined income. The IRS calls it combined income, and the Social Security Administration does as well. And then there's some places in the Social Security Administration's website, they call it provisional income. I just refer to it as combined income, since that's what the administration or the IRS calls it. Combined income is simply your adjusted gross income plus tax-exempt interest. So if you have a bunch of tax-free bonds, they're going to add that back in, plus 1/2 of your Social Security. All right? That number is what determines your income level in those Social Security taxation thresholds. So, for example, if you are a married filing jointly person, and I'm going to get these numbers off the top of my head, I think they're right. Between $0 and $44,000 in combined income, none of your Social Security benefits are taxable. But once you breach that $44,000, then it starts to pull some of your benefits in at the 50% taxation level. Maybe it's $32,000, and then $44,000 is the top. Anyway, I can't remember exactly what those brackets are, and I'm not looking at them here in front of me. But the point is that the higher your combined income, the more of your Social Security that you pull in. That's what can then cause what they refer to as the tax torpedo.
Mm-hmm.
And some people think that the tax torpedo is just for those middle income people, that higher savers don't have to worry about this, but that is not the case. Give you an example here. Let's say, John, that you retire, and let's say that your income need is $20,000 per month.
Okay.
In retirement, net. That's the amount you want to live so you can travel to Thailand, do all those things that you do in Asia, right?
Right.
Because that's somewhere that you really want to start spending some more time. Okay?
Yeah, sure.
Because the Airbnbs were what? $500.
Yeah.
We were talking about this before we recorded. If none
as
of
you
this
were
is making sense to our listener.
mispronouncing various Thailand city names.
Oh, absolutely. You know I'm going to maul it. It's going to be horrible if I say it. So let's take a married couple that has a $60,000 combined Social Security benefit. So let's just say that hypothetically, they are both receiving $2,500 per month in Social Security benefits.
Okay.
Add that together, what do you get? $5,000. Times 12, $60,000 a month. Very easy.
A year. Yeah.
Very easy math. Now, in addition to that, they also take $50,000 out of their IRA to live on. Okay? Now, at that point, I don't remember exactly what the percentage is of their Social Security that's taxable, but it's starting to move it through the grids, and they are now right past that part where 85% of their benefits become taxable. And here's where the torpedo hits. So let's say this year that when he went in to enter his sale and distribution request on his IRA, he put a 1 at the end instead of a 0.
So $50,001.
$50,001 came out. That $1 in additional distribution seems like it would increase your taxable income by $1.
Right.
But it didn't. That $1 in additional income increased his combined income, which then pulled an additional 85 cents of Social Security into taxation. And so $1 in distributions equals $1.85 in additional taxable income. And here's why, going back to your $20,000 per month example, Here's why that could happen with someone that is a really good saver, like a lot of our listeners are, but they're not yet paying the full amount on their Social Security benefits. A lot of these people retire and they have taxable accounts, right? Let's say that you're taking that distribution out of a taxable account where you've accumulated $1 million.
Mm-hmm.
Your cost basis on that account is, I don't know, $700,000. You've got some in a money market fund in there. You've got some fixed income, and then you've got some ETFs that have gone up in value. And when you're taking a distribution, some of that is a capital gain. And then every year you're also getting some interest income. You're getting some dividends that are paid out. But overall, your income at that point is really pretty efficient. So you've got a little bit coming out of that that's taxable, a lot that's coming out of that that's not taxable, plus your Social Security. Well, that puts you in a situation where your taxable income is not very high. And for purposes of Social Security's calculation, your combined income is not very high. And then you decide that, well, you know what?
I need that extra dollar.
I need that extra dollar for my IRA. And you pull it out and you get the shock. Now, $1 is not going to shock you. What would shock you potentially is a $10,000 distribution, right? Where you go, well, we've got this plan in place with our taxable account. I don't want to mess with that. But boy, I really want this boat. And I want this boat so I can take these girls out. And I can have this side hustle. And this boat is going to cost me $10,000 because I found a screaming deal on it. Well, now you take $10,000 out of your IRA, and how much gets added to your taxable income? $18,500.
Right.
Because it starts to pull it through. Now, you do get to a point where 85% of your benefit is already taxable, and those additional distributions don't have that torpedo effect because it's already 85% taxable. It doesn't add anymore, but there is a zone in there where those additional distributions can be very dangerous.
Right. And the main thing is you've got to know where that is for you, right?
That's why before you, especially if you don't know that, before you do any distributions, you need to do some testing, right? I think we shared the Tax Act calculator that's available online. That's a pretty good one because you can look at future year and you can say, well, what happens if I take this amount in IRA distributions? We use a tax software that will let us model it out and get really specific on exactly how it's all going to flow through in terms of the credits and everything. Is it going to put you over the limits, under the limits? We're going to be able to see all of it. That's probably overkill for most retirees. Plus, I think it's, I don't know, $4 or $5 grand a year that we pay for it. But that's probably not as much as your tax software costs, though, is it?
Well, my tax software is a cheaper cost initially, but I pay per return.
That's right. Yeah.
Yeah.
So you do need some kind of good tax software to be able to model some of that out so you can understand how that works. And then we have the taxable brokerage account. So we've covered IRAs. Everything that comes out is going to be taxable income, ran through your ordinary rates. We have Social Security, may or may not be taxable. If the amount that is taxable is going to be taxable as ordinary income. But then we have taxable brokerage accounts. Now, John, if I ever got a tattoo, I think it would be one of those flourishy hearts that said, I love taxable accounts. I think that's what it would say. All right. Now, I don't know where I would put this tattoo.
I'm going to get you a gift certificate.
Well, I would hate not to use it, but I'm not too sure that would happen. But I absolutely do love taxable accounts. I think they are the unsung hero of retirement planning. And most people don't put enough into their taxable account. It is the account that is the greatest addition to your flexibility in retirement that I think exists, period, because it will let you be very tactical when you're looking forward, like in our annual alignment meetings that we do. We're able to be very tactical when we are looking at where should your income come from this year. Oh, that's right, you've got this payout that's going to happen. Well, instead of your IRA, let's take it from the taxable account or take X dollars from the taxable account. whatever, right?
Right.
It gives you the flexibility to have another stream to pull money from.
Yep.
I love taxable accounts, but you get this big old multi-part 1099 on a taxable account. That's your, 1099 INT, 1099 DIV. I can't even remember what the rest of them are called, but it'll be this consolidated 1099 sometimes where they'll give you everything, but it's not a real easy 1099 to be able to look at and understand. What's the one on capital gains called? The 1099.
It's B.
1099B. Yeah. So all of these different pieces. And that's because within that taxable account, there are all these multiple levels of taxation. So we've already gone through some of this, right? A lot of this stuff is taxable at preferential rates. So you've got capital gains and dividends, the qualified dividends, that are taxable at either 0%, 15%, or 20%, depending on your other income, right?
Right.
So if you're able to manage your distributions from your IRA, then you may be able to offset how much those capital gains are going to cost. And in those years where you might have to realize a capital gain, then you might be able to pull money from your taxable account, keep your income below that capital gain threshold, where once you add that to any other taxable account you have, you might not have to end up paying anything on that capital gain.
It could be basically free.
Yeah. You've got the capital gains, you've got the dividends, but then you've got interest income. And this is one that has slipped up in the last couple of years and slapped people upside the face when they went into Schwab and they said, well, look, I'm going to get the Schwab money market fund, because there for a while it was around 5%, right? And it's still in the 4s.
Mm-hmm.
Well, with just the law of numbers, I mean, that can add up pretty quickly.
Sure.
Right? If you've got a couple $100,000 there and you say you're building a spending bucket and you don't really know what else to do with it, so you just put it in the money market fund, it's earning, 4.15% or whatever that rate is. Well, then at the end of the year, you get this 1099 that shows $8,030 in taxable income.
Yep.
That's interest income. And now that's taxable at ordinary rates. So in addition to understanding what all the tax rates are, you've really got to keep a good mental running of what you have that's accumulating throughout the year. If you realize any capital gains, you've got to keep that in mind. If you realize any capital losses, you got to keep that in mind, because that's going to offset those capital gains.
Yep.
All of that has to be kept top of mind when you're dealing with these taxable accounts. And then you also have to remember that capital gains, dividends, all of that will add to that taxable income, which then will increase when you're looking at the way that they calculate the modified adjusted gross income for purposes of Medicare, and then the net investment income tax. And if you're before Medicare, the ACA premium subsidies, those capital gains and all of that stuff get counted in with that as well. So let me give you an example here.
All right.
Susan is retired. Guess how much Social Security they have? $60,000. Same as in the example that we used before. They've got some dividends that have been paid in their taxable account, a little bit of interest income, a little bit of capital gains. Nothing much, right? It's pretty simple. If you just look at the way they're living pretty modestly. Their Social Security income plus a few distributions out of their taxable accounts, all it takes for them to live. They're living pretty good off of that. At that point, their Social Security benefits would be taxable at about 18.5%. That's the percentage of their benefits that would be taxable as ordinary income.
Okay.
Right? So really low. Now, during the year, they decided, let's sell this stock that we've had forever, because I think we can stay in the 0% capital gains rate, because we're not going to have much income this year. So they sold a stock and realized a $50,000 capital gain.
Right.
Now, that alone is going to start to drive their Social Security benefits through the taxable levels and expose more of that.
Mm-hmm.
And this is something that I see happen all the time. But then their advisor said, hey, the market's down. Market's dropped. We've got all this talk on tariffs or whatever the problem du jour is.
The excuse du jour.
Yes. Let's do a Roth conversion. And you're not going to have that much income, so let's convert up to whatever, right? And let's just say that they decided $150,000 is the amount they're going to convert. Now, that advisor didn't necessarily know about the capital gain, that they had done personally earlier, or maybe he did know about it and just didn't know how it would affect things. But they did the Roth conversion. That means that by doing that Roth conversion, now they've had an additional $32,000 of their Social Security benefits added as taxable income. It jumped them straight up to that 85% of benefits taxable. Their 0% capital gains rate is gone. Now they're in the 15% bracket. That's a $7,500 capital gains tax that they're going to get hit with. It also triggered the IRMAA. They're not going to get hit with it that year, but 2 years later, they're going to get a nice letter from the Centers for Medicare and Medicaid, or Medicaid and Medicare, whichever one it is. And they're going to have to pay between Part B and Part D $6,000 to $7,000 more, depending on where premiums are at that point in time. And it also hit them with the net investment income tax, because the combination of all of their income sources put them above that. And not all of that was subject to the NIIT, but the amount that was over that modified adjusted gross income amount, that is subject to that net investment income. That added another $800 to it. And so if you look at their total unintended tax consequence, they did this Roth conversion. They thought it was going to cost them about $25,000. Because if you just look at ordinary income rates, you go, well, this is where we are. If we add 150 to this, easy peasy, boom, it's going to put us here. It didn't. It put them there plus another $12,000.
Right.
Because it started to drag everything else through there.
Yep.
So taxes can certainly get more complicated when you retire. You've got to understand how Social Security is taxed, how capital gains and all of that is ran through the preferential rates. And I would say the easiest way to do this is to have a plan in place, right? It doesn't just need to be a single year plan, which I think is one of the downfalls of a lot of retirement plans, is that we identify, let's just say Roth conversions, for example. Identify, okay, well, Mr. and Ms. Client, you need to do a Roth conversion, and I suggest you convert up to the 12% bracket. Well, that says a lot about how much we pay in taxes this year, but what is that impact over the long term? All right, it goes back to what I was saying earlier. That's very tactical for this year, but how strategic is it?
Right.
Does it really go out over the long term and have a long-term effect on you? I don't know. I can make the argument that it may not. So you need a long-term plan that's going to look at the integration of all of these pieces that's there, for sure. So when it comes to retiring, taxes are going to get more complicated. I just don't think there's any way around it. Now, that doesn't mean that you're going to have to go out and hire a tax advisor or a CPA, right?
Right.
It's not going to be complicated like if you bought an apartment complex or the guy that had the boat that he was depreciating and all of this stuff. You're still going to get the necessary 1099, so on and so forth, from your custodian. So whoever is holding your funds, they're going to send you the paperwork that you need.
Right. Your return is still going to be mostly data entry.
It is. Yeah. It's still going to be fairly simple. But understanding how all of those pieces integrate, I'm not sure that's where a CPA is going to help you that much anyway.
Well, and this is where we've talked about this before, but the difference between prospective planning and retrospective planning.
Right.
Or, CPAs often, vast majority of what they're trained to do is to look historically.
That's right. Rear view mirror time.
You're looking at what the company has done and preparing financial statements.
Yeah.
You're looking at what the company has done and auditing that work.
Yeah.
You're looking at what the company or person has done and you're filing the necessary reports with the IRS, right?
Mm-hmm.
All of that was retrospective.
Yeah.
And that's the bulk of their training.
Yeah.
Is retrospective. What you're talking about is entirely prospective.
Yep.
When you get to the retrospective, it's already done.
Yeah.
Can't fix it.
Nope. The curtain's closed.
Right. And so you've got to have something that's planning prospectively.
Yeah.
And again, that's where, like what you were talking about earlier, when we kind of went off track with the one big beautiful bill that's lingering out there at the moment. You're meeting with those folks at the beginning of the year, but then you're meeting with them again halfway through.
Right. Yeah.
You know, what have we done?
Yeah.
And do we need to adjust
Yep.
and make a change before we get to that end of the year and it's already a done deal?
Yeah. The most important thing to take away here is understand how these taxes can be more complicated. They're going to integrate, that nothing is going to happen in isolation, that just about everything you pull from is going to have a ripple effect somewhere else. Roth accounts have the lowest ripple effect. Sometimes they have no ripple effect, in fact. But just about every other type of account that you pull money out of or any source that you get income from, it is going to have some sort of domino that knocks over another domino somewhere else. And that's you just have to think about it as a system that now you navigate through. You can mitigate some of those taxes with planning, but you can't ignore it. Right? You can't just look at it and assume that, well, all my stuff's taxed the same way, the same as it was when I was working, because it's not. It gets more complicated. Very good. John, let's wind up the episode there.
Cool.
And remind our listeners, bigpictureretirement.com. You can go there, ask us a question, but also on Apple Podcast. We'd love to have a review and rating from you. 5 stars is preferable, but we love seeing those come in. Those are always fantastic. And as always, we thank you for listening. Thank you for viewing if you're watching us on YouTube or listening to us on whatever your chosen podcast platform is. Until next episode, thanks so much for listening.